Hi everyone, Chad Shoop here, and at the beginning of the year I made a big prediction that I expected 2019 to be a very profitable year for the stock market and for stocks to rise. And at the time that was a very easy call to make because we were coming off of 2018 where the S&P 500 dipped about 6%. So there's only been 4 times since the Great Depression that the S&P 500 has fallen 2 years in a row. So it's an easy call to make to not expect that to happen in 2019 and to instead expect profits to continue to grow. Now, after the start of the year, we've already seen a double-digit gain, as much as 10% over the first 2 months of the year in the S&P 500. So this nice rally that we got started off with, we have to adjust our expectations for the rest of the year because we're not going to continue to grow at this exponential rate in the stock market. So the next big move in stocks is actually going to be a pullback. We're going to go through a bit of a correction here in March and April, and it's going to have nothing to do with the trade issues or tariffs or the Federal Reserve. Instead, this is all going to be tied to earnings, because what we saw during this bounce that we've had so far this year as companies are reporting their earnings for the fourth quarter in 2018 is that the companies with the weakest earnings results, these are companies with negative earnings, they're missing results, they're coming in below analyst expectations, and instead of companies punishing those stocks, they're only down about 0.4% on average, and that's over the 2 days before and the 2 days after a company reports earnings. Now 0.4%, that's still down, but when you look at the 5-year average, it's usually around 2.6% that these stocks tend to drop. So their market is clearly not punishing stocks that underperform analyst expectations, and they're rewarding the companies that are beating analyst expectations. But it tells us that the rally so far this year is not really about earnings, because earnings are not all that strong. The rally is just based on market sentiment, and coming off those December 24th lows, the market has just had a big bounce in it, and it's overcoming that negative sentiment that we started off the year. And it's really, the earnings have not helped drive the stock market rally. So what we're going to see in March is analysts start to pull in those expectations and start to get back to valuing these companies based on earnings. And that's going to lead to a bit of a correction through March and as we head into April before we start to get the bulk of the next earnings reports, which are really going to dictate how the stock market will go for the rest of the year. Now, I'll stand true to my prediction. I still expect stocks to be higher by the end of the year. It's not going to be a smooth ride ahead. We're going to go through some volatility. There's going to be some bumps in the road, but it's all going to be for the greater good of the stock market, because after we go through this correction, stocks are going to turn higher before they hit those December 24th lows again, and the S&P 500 is going to be renewing its uptrend, and that uptrend is going to be one that's going to take it to new all-time highs in the stock market, maybe even before the end of this year. So we're still expecting the stocks to go through a massive rally, and it's going to be one that you don't want to miss out on. So instead of trying to time this pullback, just instead be aware of it and be ready to ride through these bumps over the next few months and stay invested, so that way you can profit as stocks continue to rally throughout the end of this year and into 2020. So that's all for my video today. I hope you enjoyed it. Be sure to click the link below this video to view the full article. And until next time, I'm Chad Shoop.